Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
You're listening to The Macro Brief, the podcast that looks at the issues driving financial markets across the globe. This episode was recorded for publication on the 18th of September 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to The Macro Brief wherever you get your podcasts.
Hello, I'm Piers Butler in London, and welcome to The Macro Brief. Here at Global Investment Research, we don't just focus on traditional forms of finance, we're also tracking digital finance and how it is transitioning from niche to mainstream. Now, this is a new topic for many people, and we're here to help you out. So today, we're looking at the various types of digital money, how they work, and what they do, as well as one of the key technologies behind digital assets, blockchain. Daragh Maher is Head of Digital Assets Research, and he joins me in the studio. Daragh, welcome back to the podcast.
Lovely to be back.
So the last time you were on the podcast, we talked about crypto and why we should be thinking less about Bitcoin and more about stablecoins. So I thought today we would broaden the discussion and talk about digital money. Bitcoin, Ethereum, Tether are all essentially one type of digital money, and there are two other categories. So firstly, tell us about those.
Sure. Well, I guess that first grouping is what you might collectively call it private digital money. Then the other two groupings are, if you like, central bank digital money, central bank digital currencies, CBDCs, is generally how they're referred to. So that's, if you like, legal tender issued in digital form by a central bank. It is what it does what it says on the tin, if you like. The third form are tokenized deposits, which sounds complicated, but essentially that's commercial bank money. Now, commercial banks already issue money. When you go and get a loan off a commercial bank, they're issuing money. This is saying, and then you can, of course, if you're not spending it, Piers, you can put it back as a deposit for a while.
Unlikely, but...
Unlikely. And essentially what this form of money would be, you tokenize, you digitize, if you like, those deposits so they could be used for payments and moved quickly and cheaply around the world. So they're the three big blocks: private money, central bank digital money, and in a way, commercial bank digital money.
Okay, so let's start with central bank digital money. It wasn't that long ago that there was a lot of talk about that type of digital money. And in a way, there was an argument that Bitcoin would fall by the wayside if central bank digital currencies existed. Because why would you hold Bitcoin when you could hold a central bank digital currency that was essentially guaranteed by the central bank and on which there would be no credit risk? And yet, they don't really seem to have come through that strongly. I mean, is there an actual central bank digital currency in existence?
No, there are a handful, but literally just that, like two or three, and not in kind of, if you like, significantly large economies. It was, I guess, 2020, 2021, CBDCs were like all the talk.
Yeah.
But then so was sourdough bread, right? At the end of the day, and I know some people are still making sourdough, but it's not the thing it was. And in a way, I guess CBDCs have gone through a similar cycle. Part of that, I guess, was the rise of Bitcoin. You had this digital form of money that was already out there. So what would a CBDC solve for? That was part of the problem. There was issues for central banks about whether if they introduced them, would that undermine the banking system? Would there be costs associated? Would the population think it was Big Brother watching?
Of course, yes, that's right. The privacy issue was that you would be overly monitored.
Yeah. Which, depending on your culture, you don't mind that. I mean, my wife always says, who cares if you're monitored so long as you're not breaking the law? So there you go. So you're competing on that spectrum of kind of cultural expectations. And for some central banks, that privacy issue, it reduced the appetite when they did polls of, hey, how popular might this be? So it's kind of stalled, but it's definitely coming back now as a conversation, maybe like sourdough.
Maybe it will rise like sourdough. Let's talk about the third category, which, to be honest, I was really completely ignorant about, and which we should all know about because apparently, according to you, it's a sleeping giant.
Potentially, yeah. This is that commercial bank digital money. Yeah. The phrase they use typically is tokenized deposits, right? And first of all, they're big, right? If we look at the 5 major currency blocks, so what are we talking? Dollar, sterling, yen, euro, China, the deposit base there is around $100 trillion. Now, I'm going to give you a point of reference. $100 trillion against stablecoins, which are $250 billion, or cryptocurrencies in total, which are $4 trillion. So you're talking 4 against 100. So digital, or if you like, the deposit base is massive. So
is your point that if you take that huge deposit base and you start to move it into a digital format,
you've got scale.
Suddenly you've got a giant.
You've got scale.
So how is that starting to happen? How long is it going to take?
We start small. From acorns, Piers, from acorns. I think the other significant help is that, remember, this money already resides within banks, the normal banking infrastructure. So all that anti-money laundering angst that you get around cryptocurrencies, all the counter-financing attempts, all that kind of stuff is kind of covered, right? You're in that guardrail, that ecosystem already. That's a help. These tokenized deposits can also offer you yield. Stablecoins, you may remember from our previous conversation, issuers of stablecoins don't offer you yield because they want to keep the yield.
Yeah.
So there's a few advantages. I mean, at the moment, you do see them operate, but if you like, within a bank's own garden. So like HSBC might have tokenized deposits for people operating within the HSBC ecosystem. We need to get these tokens speaking to each other across banks.
So is that why you say that tokenized deposit dominance, so to speak, isn't guaranteed?
It's not guaranteed. I mean, 2020 we thought CBDCs were guaranteed to be the dominant play. Partly that, partly also, will it be judicial? I don't know. By the way, I guess is that the right word? Not in terms of law looking at them, but if you're operating in one jurisdiction, another jurisdiction, are you going to get conflicts there, regulatory conflicts? Plus, there's going to be stablecoins are going to take this line down. CBDCs are going to take this line down. And also critically, incumbent financial pay rails, of this world. They're not going to say, hey, we're doing nothing. We're just going to have our Kodak moment and let somebody else take over our business. So everyone's adapting. So there is competition in this area.
Which actually brings me neatly to your recent report, which intimates that it's not a harmonized digital money world. In fact, it's a multipolar one where we have many digital ecosystems. So this is a bit probably forcing the analogy, but does that mean that there's going to be a cacophony before we all act in concert?
Oh, nice. It's possible. The problem we have here is so we described those big blocks of money, right? And so let's think in simple terms of stable coins, CBDCs, and tokenized deposits.
Right.
Geographically, different jurisdictions have different views on, hey, this is the way forward. US is super keen on stable coins and actually is aiming to ban CBDCs.
Yes, that's right. In your report, you have this fantastic chart that looks at the anatomy of digital currency ecosystems in the US, Europe, Japan, the UK, and China. And the difference between the US on one side and China is really striking. How has that come about?
How does that happen ever? It's such a rarity, right? Such a rarity. Because there's different priorities here, right? So the US will look at their setup and they'll say, look, we've got stable coins. They're dollar denominated 99% of the time. So we can use stable coins for our digital payment system. It ensures dollar dominance. Also for the Republican Party, privacy concerns are an issue. So central bank digital currencies were kind of a non-starter, if you like. And so that's kind of the US perspective. China, rightly or wrongly, perhaps doesn't have as much angst about surveillance and privacy. And they were more interested in the democratization, access to finance, to digital payments. And so they've gone down the route of promoting central bank digital currencies and Pioneer and a massive pilot scheme already underway. But they didn't particularly like cryptocurrencies, including stable coins, because they're mindful of wanting to control capital flows. And also they're wary of, I guess, more the Bitcoins of this world, that you could get destabilizing speculation in Bitcoin and other cryptocurrencies as an asset. So they wanted to kind of limit that. But you end up, with this polarization, not for any weird reason, just for, in a way, domestic policy considerations.
Underlying cultural issues, I guess.
Yeah, definitely part of the mix.
How long does it take before it becomes a less multipolar world? Or is that something that we're going to just have to accept?
I mean, sometimes with emerging technologies, you do see a competition to be who's going to be the dominant, who is going to be last man standing. for those of us old enough, and sadly we are there, do you remember VHS and Betamax? And, and it wasn't even necessarily the best technology that wins out. Is right. Who gets critical mass? Who gets traction? I think in this situation, though, we can see, we talk about multipolar. I think you can end up with an infrastructure where there's a place for everyone, which sounds beautiful and hippie-ish from the 70s, but I think that's the reality. There is a place for stable coins, for tokenized deposits, for central bank digital currencies. It's a question of who will be dominant, but what will be critical is that they can all speak to each other.
Well, that's right. Yes, that comes back to your point about regulation, I guess.
Yeah, regulation helps because then you say, okay, we know the rules of the game, and therefore, we can accept payment in different formats across different jurisdictions, and that all works out well. But also, a word I think we've used before, interoperability, which sounds very long, but all it is essentially one blockchain.
Can they speak to each other?
Can they speak to each other? And I think where I fall back here, particularly for tokenized deposits, is the wonderful profit motive. It'll be in everyone's interest to get this stuff working, particularly for commercial banks. And so that might be a catalyst, and what gives them, in a way, a competitive advantage is that they'll want to pursue interoperability, talking to each other in order to ensure that these things work. But that relies, of course, as we say, on, getting the blockchains to speak to each other.
So in our last conversation, one of the things we talked about in the context of regulation was this analogy that they were sort of like piping in the proverbial house, that you can have this fantastic 6-bedroom house and what have you, but if you don't have good piping, then it ain't going to work. And you were saying that regulation was key and was kind of analogous to effective piping. But there is another form of piping underlying digital money. In fact, you talk about it as the cornerstone technology of the digital ecosystem, and it is, blockchain.
Right.
But if I was at a dinner party and somebody turned around to me and said, "What is blockchain?" I'm not sure I wouldn't be able to explain it properly. So your challenge, and again, a terrible pun, but don't make a hash of it, which is
nice. Look, I can't imagine you're at a dinner party where you wouldn't have answered that question anyway, even if you didn't know what blockchain was. So blockchain is essentially a very elegant technology that allows you to store data in a way that is very hard to change the history of. And the other key advantage of blockchain is the technology, which involves a lot of mathematics, cryptography, including hashing, which is a form of cryptography. It allows this data to be held without a central party controlling it. So it's not like a bank account where your bank knows what your ledger is. Everyone sees the ledger, and everyone has a copy of the ledger, and what you all agree is, we add a new block, we all agree in that block, and the blockchain just gets longer and longer. That's a simplified version. If you want to listen to it for longer, I'd say go and find one of our explainers on this.
Which, by the way, they're great. And I learned a lot in the process, which hence the allusion to hashing, because I didn't know what that was about before I listened to your explainer.
But that's critical because what works here then is it allows all these payments to be made without necessarily having an intermediary. You can have an intermediary, but you don't necessarily have to have one. And it makes for very fast, swift payments and settlements. And of course, that's a large part of the appeal here.
Yes, this is the thing. Blockchain is often associated with cryptocurrencies like Bitcoin and Ether, but its applications extend far beyond digital currencies. So can you give us an example? Can you illustrate what it means in practical terms?
Sure. I think the easier way to think about blockchain is just a store of data. For them, often it's the store of transactions, right? So, you've sent Bitcoin from address A to address C. That will be recorded on the Bitcoin blockchain, and it will forever be held as a fact. But it can hold any form of data. It can hold voter records, medical records. It could hold who owns a house. We see a lot of talk, for example, recently in the UK about how long it takes to sell a house. Imagine a blockchain environment where all the records are held for your property, including council surveys, all the kind of rigmarole that you go through to sell. And bang, you put an offer in front of
goodness. I can't conceive of
it. I know, it sounds like Nirvana, doesn't it? You still pay the stamp duty, though. Yeah. So just think about it as a data store, a transactional data store. And the other key advantage of a blockchain is that it can also host smart contracts. I don't know if you want to go down that particular rabbit hole, but that again is another way of improving the flexibility of this technology to give very good commercial outcomes.
Very powerful. But obviously, that implies a huge amount of data being stored.
It does, but that's the world we're in, right?
Yeah.
And actually, interestingly, one of the challenges, we talked about hashing cryptography as being part of the blockchain technology. Quantum computing, which is another great word out there, that's a way, of course, a means to storing vast amount of data, but it also poses a challenge to that cryptography, right? Will the code-breaking power of quantum computing undermine the whole blockchain thesis? And of course, that's a whole other conversation. But what an elegant way of holding data and sharing data. And I think that's why people can dispute the merits of Bitcoin or whatever, but the merits of blockchain as a technology, I think is wonderfully elegant.
To finish, could we say that the future is bright, the future is blockchain?
Yeah, I think it'd be a nice cliche. The question is, what will sit on that blockchain? And that question is perhaps more
still
open.
very much in development.
Very much.
Well, no doubt we will have you back to talk to us about that. But in the meantime, Daragh, thank you very much for joining us.
Cheers, Piers. Nice to speak.
Before we finish, here are a few highlights from global investment research this week. In our monthly currency outlook, Paul Mackel and team outline why the US dollar faces a sliding doors moment, look at what the autumn budget could mean for sterling, and explore how domestic political developments are impacting the Japanese yen. Elsewhere, Paul Bloxham, our chief economist for Australia, New Zealand, and global commodities, has been assessing the drivers of commodity prices. Paul argues that geoeconomics, where national security policy drives and interacts with economic policy, is becoming a more important factor and contributing to price volatility. And finally, did you know that our mobile app can now read out our research to you? So wherever you are, you can listen to all our research summaries hands-free. If you're an HSBC Global Investment Research client, download our app on Apple's App Store or Google Play. So that's all from us this week. Don't forget that you can get in touch with us by emailing askresearch@hsbc.com. And please like and subscribe to the Macro Brief wherever you get your podcasts. From all of us here, thanks for listening, and please join us again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.